The benchmark NIFTY index dropped more than 600 points in a single trading session, finally closing around 22,500. During the descent, technical indicators meant nothing. Mild intraday recoveries were immediately sold into, overriding every standard support level traders rely on. Then, after the market closed, former U.S. President Donald Trump published a social media post stating he would halt the conflict for 5 days. Specifically, he announced that there would be no attacks on power plants in Iran. Because U.S. and European futures trade up to 23 hours a day, the reaction to this single headline was instantaneous. A massive short-covering rally suddenly erupted across global markets, immediately reversing the severe downward pressure with an explosive surge upward. Market mechanics are currently operating in a binary regime. Underlying economic data is entirely subordinate to unpredictable, single-variable headline news, where one negative report triggers a crash and one positive post triggers a rally. When faced with this kind of volatility, institutional practitioners face a strict mandate. They must hedge their portfolios against further downside risk. The reflexive action is to aggressively purchase short-term put options. A put option is a financial contract that gives the buyer the right to sell an asset at a specified price, serving as insurance if the market drops further. However, reacting to a binary geopolitical event by buying expensive short-term insurance mathematically guarantees capital destruction, regardless of which direction the market opens the next day. The mechanism responsible for this destruction is called implied volatility crush, or IV crush. Implied volatility is the market's forecast of a likely movement in a security's price, and when a binary event resolves, that forecast drops violently. Surviving a geopolitical market shock requires a strict understanding of volatility mathematics, rather than attempting to guess the directional price action. We measured this specific type of market fear using the India VIX. The VIX is an index that calculates the expected annualized volatility of the market over the next 30 days, based on option order books. This chart shows the recent behavior of the India VIX. Over the last few sessions, the index spiked violently to 27. To understand why 27 is an anomaly, we must look at the historical panic threshold of 30. The India VIX has rarely crossed this line. The only major global events to push the index past 30 were the COVID-19 pandemic and the collapse of Lehman Brothers. The psychology driving the current spike to 27 is the institutional fear of hitting a lower circuit, a regulatory mechanism that mandates a temporary halt in all trading if the index falls by a predetermined percentage. When a lower circuit is triggered, standard liquidity disappears. Participants are trapped in their positions, unable to sell or limit their losses until the market reopens, often at an even lower price. A VIX at 27 indicates that market makers are actively pricing in this systemic, unquantifiable tail risk. This fear directly warps the pricing of all standard option premiums across the board. We can observe exactly how this macro volatility distorts market mechanics by looking at tomorrow's specific options chain. This matrix shows the available option contracts. Look at the specific row for a 10% out-of-the-money put option. Out of the money means the current market price is currently higher than the strike price of this put contract. Despite expiring in less than 24 hours, these specific contracts are actively trading at an inflated premium of 3 to 4 rupees. Under standard normal distribution models, an index's price movement over a single 24-hour trading window is tightly bound by statistical probability. Based on those normal rules, the underlying index dropping a full 10% in one day is virtually a mathematical impossibility. It would require an event several standard deviations outside the norm. Yet, because the 48-hour deadline for geopolitical escalation expires before the market opens, institutions are forced to panic buy these very contracts simply to satisfy their mandatory risk hedging requirements. The 3 to 4 rupee price tag on a one-day 10% out-of-the-money put is an anomaly composed entirely of raw fear. It is utterly divorced from the actual mathematical probability of the asset falling that far. To understand the trap, we must deconstruct exactly what the buyer of that 3 to 4 rupee premium actually owns. This chart breaks down an options premium. Every premium is built from exactly 2 components, intrinsic value and extrinsic value. Intrinsic value is the actual built-in profit if the option were exercised right now, while extrinsic value is the extra premium paid for time and volatility. Because the chosen contract is 10% out of the money, it currently holds no real profit. Its intrinsic value is locked absolutely at zero. That leaves a massive block of extrinsic value. In this specific short-term contract, that value consists almost entirely of implied volatility, the direct mathematical representation of geopolitical fear. Now, reintroduce the social media post indicating that Iranian power plants would not be targeted. The moment that de-escalation catalyst hits the market, the systemic uncertainty evaporates. Consequently, the fear premium inside the option contract violently collapses. This rapid mechanical evaporation of extrinsic value is the IV crush. The reality for the hedger is brutal. Because they paid entirely for fear, the de-escalation headline destroys their capital. Even if the underlying market opens perfectly flat, or even slightly down, the total evaporation of extrinsic value sends their expensive short-term hedge directly to zero. There is a mathematically sound way to deploy capital and hedge against a binary volatility spike without falling into this trap. This graph compares two option contracts. On the left is a short-term, next-day expiry. On the right, a long-term, next-quarter expiry. We apply a simultaneous systemic shock to both curves, a sudden 20% drop in implied volatility. The short-term contract has no time to recover. The IV crush wipes out its value, forcing the curve to zero. But the long-term contract absorbs the volatility shock. It takes a hit, but remains elevated well above zero. The mathematical mechanic saving the long-term hedge is time. The extended duration of the contract acts as a buffer, diluting the localized impact of the IV crush across months of remaining premium. Extending the structural duration of the options contract is the only mathematically viable defense against an extreme binary volatility shock. Options math operates strictly within the overarching geopolitical reality facing traders. When the VIX is elevated, the entire market is captive to unpredictable, real-time headlines. Relying on standard support levels or basic moving averages during a tight 48-hour window provides a false sense of security. The technicals will break. Quantitative risk managers must measure and price the volatility itself rather than simply reacting to directional price swings. Institutional risk management is not the act of buying expensive, short-term panic insurance after a shock has already begun. Instead, it is the deliberate practice of structuring long-term, mathematically sound defenses well before the unpredictable binary event ever occurs.